this segment. It's trade size mechanics for futures. Doesn't seem super attractive, but I think this is going to be a fun one that hopefully a lot of people find interesting. Errol, hopefully you find interesting. You are newer to the game here and you're learning about, trading crude oil, trading interest rates. How have you been finding your sizing? Are you just doing one contract in each, or what have you been doing?
I don't even think I have gone 2 contracts yet, or scaled in, scaled out. I'm not even at that point yet. Still kind of testing the waters with all the different future products.
And that's totally fine. The greatest place to start is the smallest place, which is 1 unit, testing it out, seeing how it feels. The problem though, and I've noticed this for myself, is if you're doing 1 unit or 2 units here, and you're doing it across the board, you have to take into account that every market has its own size and volatility. Even the small exchange markets that we try to bring everything down to a small size, Errol, but not everything is equivalent. We can't do that because if we even, as of today, Errol, made crude oil, interest rates, stocks, everything equivalent, next week it'd be different, right? Because the prices are going to move around and everything else. And so with that in mind, I found myself, especially in the last couple of weeks, I'm day trading a lot. There's a lot of volatility, a lot of opportunity out there. And I'm like, man, I have, 2 or 3 great trades across interest rates and metals and whatever, but I have 1 bad trade in crude oil. And since crude oil is bigger, I'm actually kind of cleaned out here, or I'm back to scratch when I should be profitable. And so I want to take into account the size and volatility each of these products and create a trade sizing mechanics for people that makes the most sense, that at least gets close to equating risk and reward. And a great place to start is the futures margin that pops up when you buy or sell, different between S2I and SMO, right, Errol?
Yes.
That's a yes.
Oh, yeah. Wait, was that a question?
I guess the answer is yes. I would have loved if you were like, SMO, it's a bigger futures margin, right? Like when you put on the SMO trade, it's going to take a bigger piece of your bankroll than the S2Y trade, right?
Yeah, 100%. And I was looking at it today. SMO was around 1,900, if I'm not mistaken. And then I check out S2Y, and that's usually around $200 to $300. So especially with someone with a smaller account like myself and doesn't want to take too much risk, that's why I've been trading S2Y the most, really. And that's why that one time when I was trading oil, you were getting on my head because you're like, why did you trade this product when you could have just traded this futures product? But that was really the case, is just because the buying power had increased, I think, at that time because of all the volatility, if I'm not mistaken.
That's exactly right. Great points all around. Futures margin, it moves with the market. It is like, it essentially takes in that size and volatility, and it spits out to you a number on any given day that's like, hey, this is what we see this market as moving between now and expiration. Now, a nice back of the envelope math for you, Errol, is you can take a look at futures margin, any product, any futures product, small exchange, any other exchange, what have you. And the margining system spits out a number at you that's essentially 5 times the daily dollar movement in that product. And so, for instance, say you have, let's actually do this right here with crude. Say you have right now, market is near all-time highs, so it's a bigger size. Market is the most volatile it's been in years. So you've got a big volatility. The margin's up to $2,000, Errol. Back of the envelope math telling you that market's probably going to move around $400 a day, which we've seen the last couple of weeks. That makes sense?
Yeah, I'm with you. And so, continue. No, I was just going to say real quick, I know when that was too expensive, that's when you had mentioned the pairs trade, if I'm not mistaken, for crude to still take part, but go ahead, continue.
No, great. I'm glad you bring that up, because that crude oil calendar spread is actually back to being super relevant again now that we're past the roll in SMO. Okay. So make sure you check out that crude oil calendar. It'd be SMO J22. That'd be the short half of it. And then the long would be in the next month, the SMO K22. That's a great piece that gets your margin down. And it's a great example because that trade brings your margin down significantly. And it's because that trade is meant to move a lot less than the outright contract. Same as you go on to S2Y. This is a market that even it's kind of similar to crude in that it's like, it's at highs. It's moving around the most that it's moved around, but it's still only moving around, $50 to $100 per day. It's margined at around $300. That back of the envelope math gets you to about $50, $60 per day. Now, Errol, I think you probably see where I'm going here. I want to be better at this, but I try to use these margins, these different, whether I'm day trading that kind of 1/5 the size of the margin, or if I'm trading for longer frames of mind here, using the margin completely, I can use that to kind of set like per product what I'm comfortable with. And in this example, let's say I'm comfortable with per product one SMO, which is $2,000 over the course of a month, but $400 over the course of a day. And I can size equivalently through these other products. I created all these numbers, Errol, just by looking at the margin in my platform for each of them.
No, I like that because everything's kind of relative in the market. And I mean, I think this is just a perfect showcase of that right here.
Yeah. And why you want to try to equate your sizing here, Errol, is so that you don't have your P&L swinging with just one market. Like I say, like with this correct sizing, I could have, a trade on in crude oil, a trade on in rates, and a trade on in metals, and say rates and metals are my, two winners. Of course, you want to win in all three, but let's be more realistic. I win in two of these markets, and the one bad market, being crude oil in this example, doesn't take away my profits in the other two because I've equated the size there. You don't want to have good and bad days just dependent on the biggest market that you traded.
Agreed. And is this what you were talking about beforehand when you were talking about some of the little winners you have, and then you got crude oil over here doing that? Did you take this into account when you're placing some of your trades in multiple products as well?
The reason that I bring this up is because, recently I've seen it's like, man, like I've got like today I had maybe 5 or 6 trades and 4 or 5 of them were like solid winners here. And maybe 4 of them are winners. One of them is like a scratch and one of them was a loser. And it's like, man, I'm not making as much money because the loser was crude oil. And so if you don't equate these sizes, everything's going to be left up to the biggest product that you're trading, which can make days really good if that biggest product is, the one that you're winning in, but it can make everything kind of worthless if it's the one that you're losing in. Essentially that it's diversification, right? You want to trade size so that your diversification actually comes through and it's not being outweighed by just the biggest product that you're trading.